for another episode here on So Happy It's Thursday, live from Northern Israel. Opa. Opa is an expression commonly said in Israel. It's like, whoa, yo, opa. Careful. Anyway, so what is happening that is worth the opa on a So Happy It's Thursday? Well, in the crypto markets, you'll have noticed that Tuesday and Wednesday, the YouTube Jimmies, all of them were running around with their heads like chickens with their heads cut off, panicking. They were definitely 100% in panic mode with their big thumbnails and their expressions and all those silly things they do on camera, thumbnail things. They give you the emotion of fear or panic. With their silly titles. Is it over? Bitcoin dead? Doom, gloom, panic, fear, uncertainty, doubt, right? All these ridiculous things. And, if you actually look at the VEPS information, it was pretty clear what was happening across Bitcoin and other altcoins and even meme coins, right? Frankly, a lot of meme coins ended the day up yesterday. They ended the day up yesterday, right? And a lot of, coins in general, not just only meme coins, but a bunch of meme coins, a bunch of altcoins had an up day in the end yesterday on Wednesday. Yes, some of them had a bunch of down days. Again, it was all in the VEPS, baby. It was always in the VEPS. The VEPS was telling you info all the time. See, the thing is, when you trade the low time frames, the key is to not be all reactive to nonsense and panic and just read the actual VEPS information and focus on that. By the way, that is why, for example, in our live streams at Alpha Trading, you will notice that we generally do these workflows, right? We go through these workflows. Also, not on the live streams, in the chat channel. When I post on any given day any number of charts, you'll notice I'll typically post from a high time frame down to a low time frame, right? Like the key time frames to be looking at on any given day. It's not to show you just that one snapshot and be like, yeah, that's it. Don't look at the rest of it. Don't look at it again the rest of the day. No. It's in that moment. This is the present information about this time frame. When you do your own workflow, you just got to go through the charts and look at the relevant time frames. Sorry, it's getting hard to enunciate the words here. I'm going to have to end this soon, because once again, I am under that, which is the weather. It may sound like I'm doing jolly while I'm not feeling very jolly at the moment. Anyway, you saw what's Dexter behind me? You're funny. Hello, Dexter. There's nobody here named Dexter, but if there was, I would point him out to you. And you could say hello to him if you wanted. So anyway, Bitcoin, altcoins, meme coins had, a nice drop, and a lot of them had a nice bounce yesterday as well from the bottoms, right? So a bunch of coins fell 3, 4, 5, 7%, and then bounced back up to the place from which they started. Some even ended the day higher. None of these things were really surprises if you were looking at the low time frames, right? And again, if you're trading on the low time frames, That is where the occurrence of opportunity is, right? Here's the thing. When you're wrong about a trade, you got to just get out. Here's another thing to do, to keep in mind. Let's say you're in a trade. And it's going okay, it's going okay, it's going okay. All of a sudden, like it's not, it's not running up and you're in a long, right? It's not running up as you'd like it to. Should you get out? Well, what's the information telling you? But typically the answer is yes. Right? If you don't know if you should be in a trade, you shouldn't be in the trade. Generally speaking. Second of all, when it's taking a long time to go in one particular direction or another, right, and it's not going in that direction and it can't seem to get there, just get out of the trade, even if you miss the move. Right? Even if as soon as you pull out of the trade, then it ends up going in a direction. Yeah, that's because you didn't read the information correctly. And it's better to be safe than sorry and to miss the trade and get the next one than to try to like stick it out. If you try to stick it out and you're like, oh, I'm sure it's going to go up now, and then it goes down. Then you panic, you don't know what to do. Oh, I'm going to wait till it goes back to zero, and then I'll just get out. And then you don't. It doesn't go back to zero. It drops 2, 3, 4, 5, 10%. All right, and then you start sweating it a little. What do? Maybe it hits 20%, and then what do? Right? Because of your leverage or whatever. Maybe you took 2x, 3x, 5x, whatever, something crazy, right? And you might think to yourself, what are you talking about? 5x is crazy. That's totally normal. No, it's not. It's not totally normal to use leverage on a volatile asset that moves multiple percentages in a day. That's not normal. It doesn't mean it can't be done. It doesn't mean it doesn't happen. But the vast majority of the crypto market that uses leverage is basically blowing their wad, getting wrecked because they don't see the damage the leverage is causing them, right? Every time you use leverage, right, the leverage you use pulls that liquidation level closer to your entry point, right? So if you use 2x, it's quite far away still usually. If you use 3x, getting closer, 4 or 5x, it's still, if it moves like 25% or something, you're out of there, right? If you're using like 10x leverage, I mean, if the price moves 10% away from you, even less, you're wrecked, right? And a lot of people use 10x. And is it possible for a price to move 10x in a volatile asset classes where we see prices move sometimes 100% in a day? Yeah, it's absolutely possible, obviously. It's very possible to get wrecked on a 10x move, right, that goes the wrong way against you. In fact, it happens all the time, and in fact, exchanges count on it, right? And that's why you got to be real careful. Because remember, if you use 10x leverage, if the price moves away from you 1%, that's a 10% difference on your P&L, right? So if it moves 10% away from you, that's 100%, and you're wrecked. And in fact, you're wrecked before that because of the trading fees and whatever else you got to pay to the exchange, right? So, plus there's the liquidation fees. So by the time it gets to even 70%, 80%, you're right on the cusp of getting wrecked, if not already wrecked. Just letting you know. And the solution to that is don't use leverage, right? Or use it sparingly and extremely lightly, right? You'll go crazy, use 2x, 3x, and manage your risk extremely well. Like when the trade goes against you, you just get out. Let's put it this way. It feels a lot better. Let's say you have $1,000 in your account. Okay, whatever, just as an example. And you place a trade using 3x leverage or whatever. It feels a lot better if the trade goes against you to rip the Band-Aid off when it's like 27 cents, 30 cents, or $1 against you, than when it's $11 or 20 or 50 or 100 or 200 or 300, right? Because if you lose $300 out of a $1,000 account, you're down to $700. And if you lose $1 or less, or you lose $10 or less, you still got $990, dollars or more. As long as you don't make that same stupid mistake again, right? I mean, it really is really simple. Buy low, sell high. The problem is than anything. Right? Let's say you just want to place limit entries, okay, and limit exits, so you save on your exchange fees. And then you see it's getting towards a low, and you want to buy. And you try to buy, your order doesn't get filled because you don't have a big enough position or whatever. Okay? Or you put in the entry, but by the time you hit entry on your order, the price had already moved beyond where you were, and it starts moving in that direction. And you try to place it at the next price. So now you're chasing it, and it doesn't get filled again because it bumps up again, and so on and so forth. And this goes on for 3, 4, 5 minutes, and you're like, "Oh, I gotta get this." So now you convince yourself you have to get this because otherwise you're gonna miss the big move. Then you get in. As soon as your order gets filled, price reverses direction, and suddenly you're in the negative immediately from the time you enter your trade. Now you're just hoping and praying it goes back up to where it was when you just entered it. And it goes down for a minute, and you're like, "God, whatever, it's just a minute, it'll go back up." But it doesn't. Wait another minute, it'll go back up, it'll go back up. It doesn't go, stays flat or dips a little, it gives you fake hopium. It bounces up a tiny bit, then comes back down. Bounces down a little bit, and then bounces a little bit back up, but not back up to where it was. So its candle is a little bit down. This happens all the time. I see it. I see people suffering this all the time. Right? And then another minute, and another minute. Soon you're 4 or 5 candles past your entry point, and maybe you took leverage, maybe not. Now you're down anywhere from a 0.25% to, or maybe 0.1%, all the way up to 1%, depending on how volatile the asset is, or whether you took leverage or whatever. Should you get out? The answer is you should have gotten out after the first candle. In fact, you should not have entered the trade. You have to be okay with missing trades, because you are okay with it by definition. Right? You got to remember, you get statistically 0% of all trades on the market. That's how many trades you get. Right? If there's billions and trillions of trades on the market every week, right? Any given second, HFT firms are running bots that are running millions of trades per second per bot. And they have a whole bunch of bots running in these big machines they run. And each of them is capable of running millions of trades per second. And there's 60 seconds in a minute. And there's 1,440 minutes in a day. So they're running literally billions of trades every day at each firm, right? So in an aggregate week, we're talking trillions of trades, right? Which means if you run 1 trade, 10 trades, 100 trades a day, your trades are statistically insignificant. If you run 1,000 trades a day, your trades are statistically insignificant. I don't care how big your position size is. Your trades are statistically insignificant. You run 0% of all trades. Sure, you can say, well, I run 0.00000000000000001% of all trades. Maybe. That's statistically insignificant compared to the market. There's this notion that you shouldn't miss opportunity. You always miss opportunity. In fact, all you do is miss opportunity, and occasionally you grab one. There's no such thing as a person who doesn't miss opportunity. It's not possible to not miss an opportunity. You're alive on a planet full of opportunity 24/7. You sleep, therefore you miss opportunity. You're not everywhere, therefore you miss opportunity. You're not in every market, therefore you miss opportunity. You feel what I'm saying? No? No, there you go. So make the most of what you make. Don't focus on what you don't. It will only serve to deceive you. Peace.